All right, let's go ahead and get started. So my name is Joe Perfetti. I will be the instructor for 443, which is Applied Equity Analysis, for the rest of the semester. I was telling the earlier class that this is actually the 11th year that we've been running this section. We started out with 30 people 11 years ago, and it was going to be a one-time thing. Now we have 170 students twice a year, 8 sections, and we're one of the top 10 classes in the whole university. So thanks for signing up. When you stop, I'll quit. So I was kind of hoping to make this a short-term gig, but it's a long-term gig. That's okay, so thank you. But in any event, so that is my name, Joe Perfetti. That is my email address at Smith. Works with this iPhone. It's also my cell phone number. Text messages are okay. They just moved our offices in a reorganization of the finance department. So on Wednesday, I am moving to 4456. Don't have a key yet, but that will be the office that we'll use. Generally, this is actually my part-time job. My full-time job is a practitioner working with real companies, which actually benefits you. So the rest of the week, I'm not on campus. I'm actually out doing stuff. So for example, I had to go to San Francisco tonight for a one-day thing in San Francisco, but I'll be back in the red eye for Wednesday. Can't wait for that. But in any event, so basically my office hours are really around this class. So before or after class. We have 2 TAs, Kush and Jake, which took the class last semester. They did really well. They will be having office hours generally on Thursday. They'll be in that office once we move to it, 4456. I gotta remember the new number. And they will be not only doing a lot of your grading, but they can assist you as a first line of defense in helping you with any of the content. Like I said, they did pretty well last semester. They know this stuff. And we're in your shoes. Basically, what the course is about is I'm going to teach you to think like a sell-side analyst. Okay, so how to do a valuation, how to write a buy-sell-hold opinion, how to think about an individual stock, recommend it, what goes into that. That's really what this semester is going to be about. It is probably the most real-world class you've taken at Smith because we were in a computer lab, which hasn't changed 11 years ago, which used to be state-of-the-art. Now we just unplug things when they break. But we actually have, this class is going to be heavily reliant on a tool called Bloomberg Professional. Is anybody here Bloomberg certified? I have one shaky person. Here's the good news. By September 14th, all of you will be Bloomberg certified and have a Bloomberg account because this class heavily relies on Bloomberg. If you don't know what I'm talking about, Bloomberg is Michael Bloomberg's company, former mayor of New York. It's why he's a billionaire. It's very expensive software, but it's the pro tool. So if you work on Wall Street, this is the software you live and breathe in on a daily basis. So essentially, you get an advantage because the school has 60 licenses for Bloomberg. There's no other school in the world that has that many licenses. We have a lab, 24 computers in this room. Each of them have a software license on it. Put it in perspective. At Wharton, they have 2 licenses for the entire MBA program. Okay, we have 24 just for this class. So you're going to be using heavily Bloomberg throughout the semester. And again, it's going to be a real advantage to the class. So very real world. This class is not about Harvard Business School case studies. It's very about real-time information. So you'll have to keep up with that as well. A few more things. Because I work, I will be missing some classes. Right? Sometimes we'll take the red eye. But for example, in 2 weeks, I can't get back from Oslo, working with SAS Airlines, but Oslo to here, finishing on Tuesday and starting on Wednesday. So there are sometimes we may not have class. So what that means is that sometimes in lieu of class, you'll have assignments, which also might involve watching a YouTube video. Now, a few years ago, I would just do YouTube videos for the classes that I missed, but the students actually said, can you also do the YouTube videos for the classes that you're here? They were very helpful. So I have a YouTube channel, which you'll be able to access through Elms. And starting with right now, I'm recording this, it will be posted for the classes that we have. So just like me, if you happen to miss some classes and you need to catch up, you at least won't miss most of the lecture that we're actually covering during that day. So there's about 120 YouTube videos up there, and we'll keep adding to them. What's important, though, is that what I did in previous semesters, I may not do in this semester. So if you do happen to watch an old video, don't assume that things might not have changed about assignments or otherwise since then. Classes evolved over time. So the other thing is there are 4 sections in this class. This one is the 12:30, but it's basically 11, 12:32, and 3:30. They're consecutive right in a row. So again, if you do need to jump to a different section, that's okay. Okay, so for example, you just have some commitment, but you don't want to miss class. You want to come to the 3:30 class, you can come to the 3:30 class, with the exception of if we have a graded assignment like an exam or a group presentation, those you can't skip sections. But otherwise, you can come as you need to for the classes. The textbook is Valuations 6th edition. I got an email from the library saying that since we're one of the top 10 classes in the whole university, they actually bought the textbook, put it in the library, and students can actually go check it out and do it for free. Now, I don't know where the library is on campus, and I assume it's somewhere around here, so you guys would have to figure that one out. But so if you want to go to the library, apparently they bought a bunch of copies in the textbook of the library. But if you don't have that, it is required to be reading along. You can either get any of the editions, Kindle edition, 6th edition, standard, university. It's basically the same stuff, but you do need the 6th edition. Don't buy an old edition. They changed the book. The other thing is project groups. About 35% of your grade this semester will be group projects. So the groups will have a big impact on your final grade. Starting next Wednesday, I'm going to randomly put you into teams of 6 plus or minus 1. And the week after that is the first group project that you're going to be working on. Because I find that if you don't get involved with your groups, we get to November and everybody's like, who's my group? And that would be very bad. So you're going to be working on groups very quickly, and that's going to be key to your grades. The other thing that you're going to have to do is groups is there's going to be the Bloomberg Trading Challenge, and then the other big group project is going to be evaluation. So about halfway through the semester, I'll pick an industry. I might pick airlines. And then you pick a company, United, Delta, Southwest. You might go overseas, take somebody like Lufthansa. But the point is, you'll do evaluation and presentation on that company. Okay, that's the final week of class. That's the big 20% of your grade group project. The other one is what's called the Bloomberg Trading Challenge. So a couple years ago, Bloomberg actually did across universities a trading challenge where they let the university students get a fictitious account with $1 million, trade against each other, and then see how they did against other schools. There are about 180 schools that participated. Since we're the #1 user Bloomberg in the world, they cut us a special deal, and we did this last semester, but basically you're going to actually have your own personal Bloomberg Trading Challenge just for this class. So you'll be broken up into 6 or 7 teams. You'll each start with $1 million starting next Wednesday, and you'll just compete based on trading real world companies, buys and sells, just equities. And basically you're going to have 2 grading periods, halfway through the semester and at the end of the semester. And the grades are very simple. Whoever has the highest portfolio value gets an A, whoever has the lowest portfolio value gets an F, and that's 10% of your semester grade. So essentially just warning you about that. Now people get a little anxious about that because everybody wants to get their A's, but it's real world. And when I tell the real world people that I use this with you, they're like, hey, in the real world, if you actually underperform your peers, you actually lose your job. So 10% of your grades, not so bad. But nonetheless, that'll be 10% of your grade. That starts next week. Then you'll have to keep up with current events. And here is the grading schema. So in this class, the assignment for any individual, grade for any individual assignment doesn't matter as much because you're accumulating points. All right, so a grade in this class is based on a 100-point scale. To get an A- or better, you need 90 total points. To get to a B-, you need 80 total points. To get to an A, you need 93 total points, regardless of how many points are in play. Right now, there's 100 points in play. Based on previous semesters, there's been 5 to 7 points of extra credit. I primarily do this so if you screw up your Bloomberg Trading Challenge, you can still make it up by doing some of the extra credit. Okay, so, but the point is, even if there's 105 points available this semester, 90 points is an A-. So it's not percentage of total, it's an absolute amount of points. Okay, and that kind of helps you guys. But that being said, 5%, 5 points towards the semester grade is Bloomberg certification. Every one of you must be certified in Bloomberg by Friday, September 14th. Okay? Now, Bloomberg certification, which we'll talk about in just a minute, basically involves taking 4 modules through the software. It involves, let's see what's in there. Basically, the key code is BMC, which stands for Bloomberg Market Concepts, but it has economic indicators, currency, fixed income, equity. Okay, if you do all 4 of the modules, it's like online training, and pass a multiple choice exam, Then they'll give you a PDF. You can put Bloomberg certification on your resume, and it actually is a big differentiator in the interviewing process if you want to work on Wall Street. Because if you work on Wall Street, one of the first things they're going to make you do is go get Bloomberg certified. So the fact that you have a leg up on that will help you. But here's the thing. Don't tell a recruiter you're Bloomberg certified if you're not. Because I can know in about 30 seconds whether you're really certified. Because not just looking up, I can start asking you questions. So the advantage is if you take it seriously, it can differentiate your resume. Now, to get the certificate in Bloomberg, you got to complete 4 modules. For this class, I only require 2 of the 4 modules, right? Equity and economic indicators. You don't have to do fixed income. You don't have to do currency and commodities, whatever the other one is. So that's not required in this class. But it doesn't hurt you to do the other 2 and get the Bloomberg certificate to put on your resume. So again, that's your choice. The cost to you to do this is 0. Right? Now, to get Bloomberg certification, you will need to get and access a Bloomberg terminal. So here's the thing. If you go to Bloomberg.com and you type in Bloomberg Anywhere login to access the terminal, it'll basically say call customer support. When you call customer support, they'll say you don't have an account, so how do you want to pay the $25,000 fee? And by the way, it's a minimum 2-year subscription, so it's actually a $50,000 commitment to use the software, right? So you won't have that. You can also download and install the software on your desktop. If you download and install the software on your desktop, when you launch the software, it'll say, I don't have a serial number. Call Bloomberg. When you call Bloomberg, they're going to ask you for the $50,000. Now, they'll let you pay $6,000 a quarter for the next 8 quarters, but most of you probably are not wealthy enough to just do that. So here's the thing. In this room, and it's been a very good kept secret for the last 4 years, we have 24 terminals. The cost to you on these terminals is 0. Okay? So this is where you're primarily going to be using Bloomberg, is in this lab. And the lab is generally open from 8 to 6, Monday through Fridays, supposedly on weekends, but not always. Check with the IT people. But basically, you'll have to do the certification through the terminal, which means you're going to have to get an account with the terminal. So how do you get an account? Now, I'm actually logged in, so let me go ahead and log out. Okay. So on your desktop should be an icon that looks like this green screen. Okay, and here's the thing. These computers, it's ironic, we have $100,000 worth of software in this room and machines that are 5 to 7 years old that break down all the time. So I was kind of joking with our dean. I was like, it's kind of a waste of money because we have terminals that people can't access. So if you are on a terminal that has a problem, please let me know because I got to keep hounding the IT people to come in here and do CPR on some of these machines, because otherwise you're not going to be able to access it on them. So for example, I know that machine right there has a problem. Yeah, that one does. His machine's having trouble loading. So help me identify those so I can walk off IT so by Wednesday, hopefully they'll get them resuscitated. But unfortunately, we're just dealing with really old hardware. Bloomberg is software, has nothing to do with the hardware. Yes? That's one of the problems, is that basically if it's not used, or if the university puts a new image on the machine, it wipes out the access key and IT has to re-add one. So as I said, before we leave today, give me a list of the computers that aren't, and I'll get IT to get them working hopefully by Wednesday. Assuming you are in a terminal that does work though, open up the software to launch Bloomberg. And it's actually, by default, the terminal is actually worked on multi-screens. Like it actually works on 4 screens. Although I actually have a friend Andy, who's a trader out of his house, he has 8 screens. It was like a little overkill. But it's actually meant for multi-screen monitors. The monitors were actually donated by Bloomberg because our old monitors were so crappy. So they came, but they didn't give us new computers. So you'll see a screen that looks something like this. And then what you want to do is hit enter or go. And down here at the bottom, you'll see the serial number. So every machine has its own unique serial number. And the nice thing about Bloomberg is because every machine at Maryland has its own unique serial number and computer number, which is tied together, they know that you're in this campus. When you create an account, they just assume that you're a student. You don't have to prove it in any way, and they give you a free account. And as long as you log in once every 30 days, the account stays active, right? Which you'll definitely be doing this semester, but even in future semesters, you can come back and access Bloomberg. So with that in mind, you will then click on Create a New Login. It's a process that takes about 3 minutes. All right, it's going to ask you a couple of questions. Are you creating this login for yourself or someone else? trick question. You're doing it for yourself. Have you ever been a terminal user before? Based on the survey of hands, the answer is no, because you're creating a new account. And then what you're going to do is you're going to type in your name, pick a login, like jsmith212 or something that hasn't been taken, it'll tell you. And then type in cell phone and or email address. It could be any email address. It doesn't have to be a UMD email address. So if you have a Gmail, you got a Hotmail, whatever, you can use the different email addresses. This is important because the next screen is going to ask you to send a code to either the phone or to that email. And then you'll type in that code, and then it will create the account and give you a temporary password, which you can then either change or keep. And that's it. That's how you create the account. And then once you have the account, you can continue to use the account with the caveat that you have to use it at the Bloomberg terminal, and you won't be able to use it at home outside this lab. Now, there is a lab on the first floor, but the rest of the school knows that lab exists. So for example, right before the 11 o'clock section, I had a PhD student that said, can I come in, do you mind, and use your terminals? And I said, no, you can't come in, we do mind. Go to the lab downstairs. Because the lab downstairs is overcrowded. A lot of people don't know this lab exists. So it's like an open secret, right? So I'm not saying that you can't use it, but just generally don't tell all of your friends here's the Bloomberg terminals, because this will get very busy outside of class time. And you will need this to do assignments as well as the certification. So once you create the account, you will log in. So I'm going to log in. Now my login experience is unique because of the 60 licenses. One is special, which I'm fortunate to have. Thank you, Dean Trianis, which is basically a Bloomberg Anywhere login, which allows me with fingerprint authentication to use the software on any computer anywhere in the world. So I can actually just browser use it. I don't have to actually be in the lab. But you won't have this. And if you have epilepsy, look away. KLV2. But so you won't have this step, but once you log in, it'll bring you to a screen. Looks like this. There's 38,000 screens and 967,000 equities in there globally with real-time data. It's also got fixed income, it's got currencies, commodities, like if you're playing the crypto market, all the data's in there to see the Ponzi scheme that you were part of. So when we look at Bloomberg, I'll just start with the certification. BMC, Bloomberg Market Concepts. That is how you will access the certification. If you say this looks like a DOS interface, yes it does, because the software was created in the 80s. And even though Bloomberg would like to change the interface, there's a bunch of old people like me who are used to the keyboard shortcuts and have everything tied to Excel. So their clients actually prefer that the interface not change. But here's the point. You go to Bloomberg Market Concepts, BMC, get a quick overview, and you can quickly see that there's a link to do this online. If you do this online, it costs $149, and you also still need access to the terminal. So don't waste your money, because the cost of doing the certification through the terminal, which you'll need anyways, is free. Okay, so basically, don't worry about the online version, just do it here. These are the modules for the certification. Economic indicators, which should take about an hour, currencies, fixed income, and equity. As I said, to be truly Bloomberg certified, you take all four. All right, to be certified for this class, economic and equities. All right, should take you about 4 hours. When you actually start the certification, you'll watch some videos, you'll read some text, and then you'll take some multiple choice questions. Now here's the thing. Bloomberg will let you blow through the multiple choice questions and still call you certified. That won't work for me. So what works for me is in the equity section and in the economic section, which are the two required, you must also get 70% or greater correct on the multiple choice questions. And by the way, the questions are not easy because the questions are not based on theory. They're actually based on the content that they tried to certify you on. So it'd be like, in this training that we just did, what was the third word on page 4? Okay, and so I'm just telling you, I tried to do the certification without reading the material. I'd regularly get 40%. Like it's literally guessing. So you really do have to kind of sort through this. But that's the thing. If you go through it, you don't get 70%. Bloomberg only lets you take it once. So they don't let you take it again. So if you find yourself failing in your certification, what you have to do is create another account. Okay, so if you have J Smith 212, guess what? J Smith 213, J Smith 214. Okay, so you can keep creating accounts and taking it again, but you got to pass 70%. So the certification on the 14th involves uploading to Canvas individually 2 screenshots or 1 screenshot, assuming you pass both, that you basically passed, and I got to see your score. Okay, so when you finish, it'll show you the score. I got to see the screenshot with the scores both above 70%. If you take it in 2 accounts, then I got to see a screenshot from each account with which ones that you have passed. Okay, questions about that? Yes?
Can you save the module and come back?
You can save and it'll remember your progress. And this is the other weird thing. So there is an additional sign up for the certification. So even though you have an account for Bloomberg, you'll have a second account to become certified within the terminal. Okay, so that's actually what you'd create the new one on. And then you'll log in, it'll remember your progress. Okay, so just FYI, it gets a little confusing there. So again, you'll have to do this during the terminal. So that's going to be 5% of your grade. All right, let's go back to the syllabus. Okay, 15% will be 3 group case study projects. So when I put you into teams, like I said, we'll have a group case study project that you'll work on 2 weeks from now. You'll have another one in October, another one early November. Basically, those will be 5% of your grade assignments. You'll turn it as a team. Okay? You'll have 25% of individual homework assignments and in-class assignments. There will be 11 of them, basically 1 a week. Because of Labor Day, they'll initially be due on Wednesday, but very quickly they'll be due on Monday. So the typical cadence once we get past the Labor Day holiday is the assignment will be given on a Wednesday. It'll be due Monday at 10 a.m. for all sections. Okay? And again, there's 11 assignments spread out through the semester, basically 1 a week. Okay? There will also be 2 midterm exams worth 5% each. One in 3 weeks, 4 weeks, late September. The other one is going to be in late October. Okay? There'll also be a final exam, which is worth 15% of your grade. It'll be in the last day of class. The Bloomberg trading competition is the $1 million teams competing against each other on equities, which we'll talk more about when we start that next Wednesday. 5% for each half of the semester. Okay, so we'll take score sometime mid-October, and then we'll take score the first week of December, and then do the grades based on those rankings. And then there'll be the group valuation project, where you'll pick a real company. I'll give you the industry, pick, and then do the valuation and analysis near the end of the semester. We'll introduce that about halfway through the semester. And that's basically what the grades primarily are based on, with the exception of extra credit, which will come in late November. Okay. All right, attendance policy, here's the deal. You're an adult. You paid a lot of money to be here. I'm not going to put a gun to your head and force you to be here, with the exception of 3 classes. All right, so if you don't want to come, I'm not going to make you come. Now, if you're behind, can't help you with that. And I think hopefully I'll give you a compelling reason to want to come, because the reason you're going to be here is because you can't just keep up with the textbooks. Like, everything we're doing is in Bloomberg, and it actually helps you. But that being said, 3 classes that you can't miss. Number 1 is on Wednesday, September 19th. Bloomberg is sending 4 people to do advanced terminal training just for you. Okay, they're going to be here all day for all 4 sections. 2 of them are XTAs, because Bloomberg will have a recruiting event that evening. And the 4 people that are coming down to train you are the people that are running the recruiting event to hire Smith people. And it's been great because most of the people they've hired took this class. And several of them were the TAs, which helped organize them coming down here. And so I'm just saying, it doesn't hurt to build relationships with the recruiters. So if you're looking for a career in Bloomberg, it's a bonus, because the people that are doing the first rounds of interviews are the people that are actually going to be here in the classroom training you on using the terminal. So long story short, that's one of the classes I need you to be at. They're putting a lot of time and effort to come down here and train us, so I expect you all to be here for that. The other 2 classes are going to be the first week of December. There's going to be the final presentations. All right, we're going to have approximately 7 teams in this section. 3 or 4 teams will present on Monday. 3 or 4 teams will present on Wednesday, December the 3rd and 5th. I expect you to be here both days. Okay, so just planning in advance. Don't do job interviews in those days. You know, if you have exceptions, let's figure it out. Like, if you have a real problem, obviously death in the family, whatever, can't be, you know, can't deal with that. Well, obviously we have realistic excuses, but generally plan Those are the 3 classes I don't want you to miss. If you miss any one of the classes, you lose 5% of your semester grade per class missed for those 3 classes. So that's the stick, but hopefully we won't need to worry about sticks. All right, what else do we have? Attendance, talked about that. Group valuation project, talked about that. Honor code. I assume you heard about this. This class had a big scandal 2 semesters ago. I put 40 people in front of the honor council. 6 were found guilty, and they got XFs. And the parents hate me. Their parents hate me when students cheat. It's interesting how they blame the faculty, not the students, for screwing up the rest of their lives and not letting them graduate. I really don't want to go through that again. So don't do it. Like, it's not worth it. This class does not require cheating to pass. It really doesn't. If you show up, you put in the work, you're going to get an A or a B. It's just, statistically, it's actually pretty good grades, because if you do the work, you're going to learn the material. So don't cheat. Don't make your parents hate me, because unfortunately, I will be forced to put you in front of the honor council, and the penalty is XF, right? Which basically means you have academic dishonesty on your transcript, and the jobs that you had will get pulled, and you won't be allowed to graduate. So that's the consequence. I really don't want to go there, and I don't want to explain to your parents why I had to do that to you. So let's not have that happen. So please follow the honor code. Late assignment policy is also important. Again, it's pretty simple. If it's late, it's not going to be graded. It's just going to be given a 0. Okay. So 2 things. 1, there's a 15-minute grace period on the timing of every assignment. So for example, if the assignment's due at 10 a.m., you have until 10:15 to submit it. If you submit it after 10:15, first the link will go away in Elms. You won't be able to submit it, and then we just won't grade it. You'll get a 0. So number 2, flexibility. Before deadlines, myself or the TAs, you can ask TAs as well for extensions, we are flexible. After the deadlines, we are inflexible. So just remember that. And timestamps matter. So for example, it's 10:13. You're having trouble submitting the assignment. Computers do what computers do. Email us at 10:13 and say, I'm having trouble submitting the assignment. Here's my assignment as an attachment. All right, if we get that email at 10:16, okay, reasonable, you probably did have trouble, we'll give it to us. If you email to us and it shows up at 1 o'clock in the afternoon, we're not going to have sympathy, we're going to give you a 0. Okay, same thing. I can't make the class, I can't do the assignment because I'm doing a all-day interview in New York. Okay, super day, great. We'll set up a different day, a different time, work out a different schedule. If you say Monday was your super day, that was the assignment due on Wednesday, you come back and say, hey, I was on super day on Monday, that's why I didn't get to the assignment. I'm going to wish you well in getting the job, but I'm not going to let you pick up the assignment. So again, before deadlines, flexible. After deadlines, not flexible. And if you do have problems, email immediately with files attached. Timestamps matter. Okay. And then finally, fill out the course evaluation. Make sure you get your Bloomberg certification. And generally, the way the class is going to work this week is really, I put up the syllabus late. So there's no assignment due this week, other than find a way to get the book, start reading the chapters, and we're going to cover some basic concepts and get you acclimated to the content. When we get back from the holiday weekend, next Wednesday, we will create the teams. And again, you'll be randomly assigned to a team next Wednesday, and that's when the trading sim will start, and we'll introduce the trading sim next week. All right. And then the other thing is the week after, week of 9/10, I am not going to be here. I'm going to be in Oslo, and I can't get back in time. Now, I'm very disappointed because apparently I'm too far south to see the Northern Lights. So don't get excited for me. But the point is, so there will be times I'm working with SAS Airlines. It was scheduled in advance. I can't get out of that. So we may not have lectures. So here's what's going to happen. That week, 9/10, 9/12, there will be no lectures. However, I'm giving you the class time to finish your Bloomberg certification because it's going to take you 4 hours. We have 170 students that need to access this across 24 terminals. There's just not enough time. So find time that week to make sure you get your certification because the certification is going to be due Friday, September 14th. In addition, that week will be group project number 1. I find that if you don't start working on the group projects early on, we end up in November and you're like, what group am I on again? And then it's too late. So basically, the first group project is that week. You'll work on it as a group. You'll submit that also by Friday, the 14th. Okay, questions? Okay, topic for those assignments will be EIC, which we'll start covering this week. Then 9/17, topic is going to be reorganizing the financial statements. We're going to put financial statements into a very specific economic format that ties to Modigliani-Miller. It's unique to this class. It's not taught elsewhere, and it's not GAAP. Okay, but it helps us, and you'll find out later, there's two values to doing it this way, helps with the valuations, helps with the analysis, makes it much cleaner. So it's a process that you're going to hate, but it's a process you're going to have to learn how to do very quickly. And it's fundamental to everything we're doing later in the semester. Therefore, the first midterm is September 24th, Monday, in class. And the first midterm is going to basically be, here's an income statement and balance sheet, reorganize it. Okay? And so I need you to understand how to do that. So I'm putting an early midterm to make sure that you do know how to do that. So just letting you know as you start your planning. Okay? Once we finish the midterm, the next 3 weeks, if you don't know Excel, you will. Because we're going to build from scratch an Excel valuation model tied to the Bloomberg terminal. That's real world. In fact, I still get emails from former students that work for banks that says, can I have the updated version of the model? I'd like to use this at my bank. Okay, so it's very real world, and it's a great model. You know, it's pretty sophisticated, and you will build it yourself over a 3-week period of time. And that's going to be the basis for a lot of what we do later semester for valuation, as well as group project work. So that's what the early October is going to be. Once we finish that, we will then have another group project case, and then we'll talk about multiples. And by Halloween, we'll then have our second midterm. And then the final piece is the month of November is just application. That's, to me, when the class gets most interesting, because we'll literally look at the headlines of the day. So what are the headlines today? Okay, here's something on Tesla, milestones, and Musk screwing up. Well, he's on acid or something. I don't know. The guy's melting down. It's not helping their stock price. But the point is, what's the impact? Like, is this a Musk effect, or is this really what's going on with Tesla? Let's actually get into the details of the valuation, figure out if there's a buy, sell, hold opportunity here. So that's why I said every class will start to become more realistic once we get to November. So that should be a lot of fun. All right. And then last but not least, group projects are done first week of December. That's when you do your presentations. I know I'm going through this relatively quickly, but any questions? Okay, so on Elms, I put up in the folder called Files, a subfolder called Lecture Notes. And today we're going to go over Lecture 1 and Wednesday, Lecture 1, which covers the content for the week. So let me... All right, so this is basically an overview slide of one of the core things we're going to be talking about this semester. And again, a lot of the work we do here is based on what the consulting firm McKinsey does. They put all their research into the valuation book. But basically, what they've done is they've said 4 things matter to valuation in the real world, and they call them the 4 cornerstones of value creation. That's the basis for our semester. So let's talk about the overview today that we're going to dig deeper into throughout the semester. So, number 1. First cornerstone. You don't create value by growing sales and growing earnings per share. That does not lead to a higher stock price. Okay? Because professional investors care about 2 additional questions. Question number 1, how much did you spend to generate those sales and profits? See, everything we do is going to go through the lens of ROI. That's what you've learned in your finance career so far. Is that that's the lens. It's not sales, it's not profits, it's ROI, right? In the real world, return on investment is called ROIC, return on invested capital. That's the standardized term in Bloomberg that we'll be referring to. It's also called RONA, return on net assets, or ROCE, return on capital employed. Those are fairly interchangeable terms, but the Wall Street standardized term, ROIC, okay? That's the return that you make. What we're going to do is we're going to compare that using question number 2, which is saying, okay, if you spend too much, we don't think the return is going to be worth it. But then, regardless of the return, question number 2 is, what's your risk? All right, we're going to risk adjust everything. And if we think the risk is too high, then again, we're going to say the return is not worth it. The risk is going to be called the cost of the capital, all right, or the weighted average cost of the capital, the WACC. All right, it's the hurdle rate. It's the rate given the risk that you have to achieve, hurdle, in order to create value. So what you're going to quickly find is this is no different than what you learned in Finance 101. It's IRR, kind of like ROIC. And if your IRR is not greater than your R, can't have a positive NPV. Well, same plays out when we do valuation. Is ROIC is like a one-period IRR, right? And over the life of a project, over the life of a company, that ROIC, IRR proxy, has to be greater than your cost of capital. Otherwise, you can't create value. Which leads to point number 2. Growth does not create value. That's another misnomer. Everybody thinks if you grow that your stock price is going to go up. That's not always the case, right? Just think about this. What matters to value in the first cornerstone is what's called spread. It's the difference between the ROIC and the cost of capital. Again, over time, that ROIC has got to be higher than your cost of capital. Otherwise, you can't create value, right? So that's the point. If my cost of capital is 10% and I'm making 6%, does growth help me? If I borrow at 10 and I make 6 and I do more of that, is that better? No, actually growth makes it worse. If I borrow at 10 and I make 16, does growth help me? Yes. So the way I want you to start thinking about growth is the accelerant to value. It's not value in and of itself. And it's the growth spread combination that matters. So that's the point. If I can borrow at 10 and make 16, grow that, and I will become exponentially more valuable. If I borrow at 10 and make 6, don't grow that because it's actually going to make my situation worse. So those are the two things, growth return, but more importantly, growth spread, that we need to focus on to understand valuation. The other key concept is about 50%, remember this one because this is a key concept, about 50% of the performance of any business is the industry that it's in. The industry is more important than the company. I want you to think about that. Just intuitively, and then I'm going to show you some data. Intuitively, if I am a company in a bad industry, it doesn't matter what I do, I'm not going to overcome the fact that I'm in a bad industry. If I'm an average company in a great industry, I can still do well because I'm in such a great environment. So that's the intuitive side. It's a guy named Warren Buffett. And one of the secrets to his success is he actually says, I don't invest in companies, I invest in industries because the industries are so important. Even when he screws up, and he says one of his greatest screw-ups was investing in IBM. It was one of his biggest disasters, IBM. But here's the thing. He didn't lose his shirt on IBM because IBM was going to the cloud, and even though they screwed up their cloud, they still were in the cloud. And so Warren Buffett's perception of disaster was, I could have invested in Google and Amazon and made a killing. IBM, I kind of was flat, but I didn't lose a lot of money because it was still such a forgiving business. So that's what I'm telling you. Industry matters. And this is why I tell you it's important to use Bloomberg, because it's one thing to just make these academic assertions. I want you to see how this works in the real world. So I'm going to open up the terminal here, and I'm going to start out with, again, you're going to get certification, so you're going to learn how to use this. You're also going to have Bloomberg Advanced Training. They're going to take you even further on how to use some of the features, but I'm going to introduce a few of them here today. So in their top line, they have a Google search equivalent where you can start typing what you're looking for. So I'm going to type in the price of oil. And here is Bloomberg West Texas or West Texas crude. And here's oil prices right now, $68.71 a barrel. And then I can go to GP, which means I can graph a price. And there are oil prices for the last 12 months through this morning. And if I switch this to 5 years, this is a 5-year view of oil prices as of 5 years ago this morning. Dim the lights a little so it's easier to see. Okay, so here's the point. In late 2013, early 2014, this is $100 a barrel. Oil's about 100. Prices plummeted, bottomed out in early 2016 to about $27, $26 a barrel. 26, 27, somewhere in that range, somewhere there. And then it was trading in the mid 40s. And then recently this year, it's run up to about 70. Today's around 69. Okay. So oil and gas industry. Take the point I just made. Do you think the oil and gas industry did better here when oil was $100 a barrel or here when oil was 45? Which part? You think they did better when it was cheaper? Why? Okay. Yeah.
Other margins better.
When the oil was 100 or when there was 45?
When they're buying, so this is crude oil prices, right?
Crude oil prices. Barrel of what?
And you're talking about for gasoline companies, right?
I'm talking about the companies that dig it out of the ground and sell it to you.
Oh no, everyone's more.
This is Exxon, BP, Chevron, Shell, Total, Petrobras, etc.
Because like if gas is less expensive, they can charge a mid-range price for consumers.
Okay. Yeah.
Well, like for all the companies, like when there's like turmoil, like a couple when the gas prices were so low, they created like a law that said like they can't like inflate the system with that much gas. Like Saudi Arabia, there was like a ban on like oil because all these companies were like creating to push oil to the markets, and like it was hurting the actual companies from doing well.
All right. Well, let me just ask you guys just a general question. So if you think about I'm Exxon, I'm Shell, I'm digging, drilling for oil, digging out of the ground or the ocean. I'm basically putting it into a refinery, putting on a pipeline or a ship to get it to you, to a gas station. And then the question is, do any of those costs change when price of oil goes down? Those are often called fixed costs. So they got very high fixed costs, which don't change regardless of the price. If the price goes down by 50%, do they fire 50% of their staff? Probably not. So let's just think about this intuitively. Do you think they made a lot of money when the price of their product plummeted by 50%? No, they're probably not as profitable, right? But before we surmise, let's actually look and see. So give me a publicly traded oil company. ExxonMobil. So I can either type in their ticker symbol or type in Exxon. Bloomberg will quickly filter it. Equity, so Exxon US equity means equity is the stock. Exxon Corp is their debt, fixed income. So I'll go to the equity part. And then one of the features of Bloomberg, you can see it here, it's called RV, is comparative analytics. RV quickly allows me to compare Exxon against its peers. Now there's different peer sets. The default one I have here is GICS, which is the Global Industry Classification Service, and Global. I can do a local one, I can do a regional one, I can do the analyst curated list, I can do a custom list. But I'm going to do global GICS, which means big oil companies around the world. Now they have all these predefined templates, but I can come over here to custom, and I can look up any data point that I want. So what I'm going to do is I'm going to look up ROIC, talk about spread, return on invested capital, and I'm going to do this to customize period to years ago, and I'm going to go 4 years ago, so 2013. Okay, so hit update. This is the industry average of all the companies on this list adjusted for size. It's called the market cap weighted average, and this is the ROIC of each of those companies back in 2013 or 14? 4 years ago. 14. So how's this industry doing? 9%? Is that okay? Exxon doing a little bit better than the peers, about 13. Okay. You'll see most companies are high single digits to very low double digits. Okay. Here is the ROIC latest year, 2017. This is $100 oil, 45. See my point? Doesn't matter that Exxon's doing better than its peers. They still are faced with the plummeting oil prices, and they can't get out of that business. So this is what I mean by industry. Industry matters. And this is the nice feature of Bloomberg, because you can go up to settings, and on these lists, one of the global settings you can set is to check market cap weighted average, so that it'll give you an average every time you look at a list. So Bloomberg is a very efficient tool for giving you industry averages, okay, and real time on any data set. So you can also do other statistics as well, but that'll be one of the things we'll do. And by the way, we'll compare this against our cost of capital. Here's the WACC of Exxon and its oil peers today. So when I define industry attractiveness, I said spread. How's this industry look on spread? Is this an attractive industry? No, it is not. And that's the way I want you to start thinking about businesses. Attractive industries are not negative NP businesses. All right, this is a negative NPV because they're basically borrowing at 9 and they're investing and they're making 5. That's not an attractive growth business. That's why they're not spending a lot of money on increasing supply. That's why instead of doing traditional oil and gas exploration, the words that they're using today are skinny, whatever they're called, the skinny drills. So instead of the big platforms to drill, it's almost like the skinny skyscrapers. They're doing skinny drills, so they can do micro drilling as opposed to macro drilling. So they have to get more efficient because the returns on capital aren't what they used to be because there's an oversupply. Right? Now, obviously, that's today. The world can change, and that's part of what we'll do with the economy is put on our forecasting hats. But this is part of the data set that we need to do. By the way, I also want to change your definition of competitive advantage. Because in traditional classes like strategy and marketing, where we all sit down, hold hands, and sing Kumbaya together, basically in those types of classes, sorry, I don't need to be harsh on them, but they're very qualitative. And what I mean by that is I've worked now, it's sad how old I've gotten, but for 25 years with a lot of different companies. And what I found is no matter how poorly performing the company is, everybody thinks they're good at something, right? Well, that's not the definition I want to apply in this class, right? What I want to apply, and I'll be very dangerously close to the line here, so don't go to my report and get me fired in today's culturally sensitive world. But by definition, if you're in this class, you're probably above average performer, right? Just to be in this class, right? In order to make it through your Smith careers. But by definition, half of you are below average relative to the other people in this class. Now that's where I'm not going to cross the line because I don't want somebody to say that Professor Perfetti called me below average, right? But technically, half of you are below average, even though you're an above average cohort. I want you to use that definition when you think about competitive advantage, right? Because competitive advantage isn't that I think I'm better than them. It's show me demonstrably that you're actually doing better than them. So in our definition that I want you to use this semester is you should have a higher than average spread if you really are exhibiting some form of competitive advantage. So using that filter, does Exxon demonstrate competitive advantage? Yes or no? Exxon. Well, what's their spread? 4.5 minus 8 is about what, 3.6? And what's the industry spread? 3.2? You could technically argue maybe a little, but they're not really exhibiting, they're just kind of like an average firm. I mean, that's the point. Exxon is an average firm in an industry that's not really creating any value right now. Right? By the way, does anybody on this list look like they have competitive advantage? Who? Yeah, I don't know who the Thailand, TB is Thailand. Whatever the oil company in Thailand, they seem to be doing well. And again, probably something to do with a captive market in Thailand, probably government owned or supported, probably some protectionist barriers, but that's the way that we need to start thinking about the business. Does that make sense? Okay, so what I'm illustrating for you is two things. This goes back to cornerstone number 1. We're going to use Bloomberg to help us assess, is an industry attractive? And we're going to use spread to do this. And does a company demonstrate competitive advantage? Are they outperforming their peers? So since there's 900,000 companies in this database, anywhere in the world, as long as you're public, who else do we want to look at? Give me some companies. Who? Apple? Okay. So we can either type in their name or ticker symbol. AAPL is their ticker. So here's Apple. Now you'll learn you can quickly save these templates. So I have a predefined template, which I call spread. And what's added on here, I'll ask you to ignore it. OPM is your operating margin. That's your EBIT margin. But here's the ROIC for last year, and here's the WACC today. Is this an attractive industry as defined by the GICS peers? Yeah, you're borrowing at 10, making 15. I'll do that all day long. How's Apple doing? Even better. Do they demonstrate competitive advantage? Yes, they do. So they're doing even better in a good industry. And that's one of the reasons why people like Apple. All right? Give me another company.
Spotify.
That was fast. Fast and loud. Okay. Oh, they don't have any comps. They're losing money, so they don't have a return. So it's pretty ugly. Let's just see if instead of best fit, I'll use GICS to see if they are put in some kind of global GICS. So Spotify, well, the average in their industry is they're all losing money on average. And they don't even have an ROIC because they're losing so much money. But hey, I have Spotify on my phone. I like it. It's great. Subsidized. All right, what else do we got? You guys are getting very specific here. No Apple or Google. It's Lulu, Spotify. Let's get practical. All right, here's Lulu. All right. Now this is clothing. All right, retail clothing. Does that look good? Industry? How does Lulu look? Yeah, they're doing even better than their industry. So throw some growth on that, and that starts to look attractive to an investor. As I said, very quickly, we can just start looking across industries. By the way, cars, here's Ford. What do you think about auto? That's a tough business.
Especially with all the tariffs now.
Yeah, and it's even getting worse with the tariffs. This is a tough business before the tariffs, and now we got a trade war. By the way, look at Ford. Ford is really struggling in a tough business. And Tesla, everybody's favorite company, that they're melting down. This is before the meltdown. They were losing a lot of money. Okay? Versus, you guys still drink a lot of coffee? All right, let's look at see how well you're helping Starbucks. Fast casual. Remember this next time you order Domino's. Cheap pizza, lots of profits. No, this is fast casual. So it's got more than just the coffee firms. And by the way, it also includes companies like I work with Aramark, who are doing outsourcing of cafeterias for schools and companies, stuff like that. So they're a big outsourcer. They're only making 7%. So it's got a different mark. So that's the point. We can start cutting this in different ways. Like here would be the analyst list of Starbucks competitors. If you just looked at coffee, it's Starbucks and Dunkin'. All right. So that's what I'm saying. We can start cutting the data different ways very quickly. But this is why you need to get certified. Because, as I said, it's one thing to academically state something, but I want in this class to get the real world evidence-based data. And that's why, in my mind, it's kind of a fun class because it gets very real is what's going on here. All right. But that's the idea of spread. And very quickly, we can get to the spreads of companies and industries and see how they're doing over any relative time frame. Okay? Now, cornerstone number 2, going back to the PowerPoint, basically says it's about cash flow, not accounting. Right? So accounting, which many of you are accountants, basically tells you, kind of like a pay stub, what the cash is eventually going to be. However, timing matters. And there's a time value of money. So I got a pay stub and I got paid on August 1st, but that's not how much money I have in my checking account today. And how much money I have in my checking account today is much more important than what a pay stub says I got paid on August 1st. So there is a timing and a time value of money that says cash flow is much more predictive of value and prices than accounting because of these timing differences. So we focus on cash. The other thing is, as a discipline, accountants generally look backwards and finance is about looking forward. That's the biggest difference between accounting and finance. Right? Accountants are about what'd you do last quarter, last month, last year. And I'm not saying keeping score is not important, but what I'm telling you is valuation is about what future cash I get. So I care about next month, next quarter, next year is far more important. Okay? So 2 things. 1, this class is going to be much more about getting a future orientation to understand what's happening to stocks. And number 2, we need a tool that gives us future data, and the regular non-paid tools don't give you that. Bloomberg gives you some insight into the future, and that's why it's going to be very valuable for us. So that leads to cornerstone number 3. Very little time on cornerstone number 2 right now. Cornerstone number 3 is about expectations. A company is worth the sum of its future cash flows. We call that intrinsic value. Now, everything we're talking about, modern corporate finance was born 1970s, Chicago. University of Chicago, now called the Booth School. That's where everything we talk about, that's where your textbooks came from. The finance professors were trained based on that, all came from Chicago. They did all the seminal work. And one of the things they did was in 1976, and you've heard of this, they put together a very important database on a punch card mainframe computer. Just think about how hard that would have been, okay? So this is before the days of like Lotus 123, much less Excel. And VisiCalc wasn't even invented yet. They had to deal with this. But the point of the story is they took 50 years worth of data for stocks, bonds, and real estate, and took thousands of assets, stocks, bonds, and real estate in the US, anything you can invest in, quarterly basis, they put in price, they put in cash flow into this 50-year database. And then in 1976, what the quants found in this big data set was a one-to-one relationship between cash and price over time. Whatever cash these assets generated became their price in the marketplace. Today, that's common sense, and we call that intrinsic value, and that really comes from Chicago proved that's the way it worked in 1976 for that 50-year period. By the way, they've updated that data set through 2017, 1926 to 2017, nothing changed. Cash equals price. There's a professor at Wharton named Jerry Siegel who went back to 1812 because he's like, we have data in this country that goes back to 1812. So 1812 through the 2000s, cash equals price. Chicago replicated the data set in Europe, Asia, Latin America, Africa, Australia, no matter where they went, long period of time, lots of companies, lots of real estate, debt, stocks, cash equals price. So that's intuitive. That's what you've learned in your corporate finance classes. So that's the point. A company is worth the sum of its future cash flows. Now on Thursday, I'm working with a company called Alphabet. So we have at Wharton the Google Marketing Academy. So 70 Googlers have flown into Philadelphia. They started on today. And I'm going to teach them basic finance about Google. And one of the things, because they're all millionaires, they don't know how to spend their stock options. They bring us in. But the point is that I'm going to basically ask them this question, which is, you're worth the sum of your future cash flows. Let's think about Google stock price, Alphabet stock price. How much cash are you going to generate in the next 10 years? To the nearest billion. Do you think Google knows the answer to that question? Because that's critical if I'm going to value them. I got to forecast their cash flows. So start next 10 years. How much cash to the nearest billion is Google going to generate free cash flow in the next 10 years? Do you think Google knows? No. We're going to laugh and we're going to joke about it because it's a big guess. And that's the point. Yet I got to price Google today based on my expectation of what they're going to do, not just for 10 years, but in the future. So here's the key, is that stock prices are guesses in the short term. Because you're worth your future cash flows, and I have to guess what they're going to be. In the long run, what Chicago proved is the prices are going to basically go back to the intrinsic value, which is what you actually deliver. But here's the rub. We never get to the long run. Even if I got into a time machine and like cable, jumped 10 years into the future, what I did in the last 10 years no longer matters. It's always the next 10 years. So even if I time machine forward, it's still the next 10 years. So there's few truisms in finance. I'm going to give you one. Price equals expectation. That's what prices are. They're always expectations. Now, that's why valuation is difficult, because we're predicting the future. So we guess, we get replaced by actual, but we never get to that future, so we're always doing guesses. See, bonds are easier to devalue than stocks because there's promises made. We know exactly when the cash flows are going to get paid back. We know exactly how much cash is going to be paid in the interest. We can do the math. But it's still not 100% certain, because what if a company defaults? Stocks, the math is actually very easy for stocks. I can remind you of that in 5 minutes. It's an annuity followed by a growing perpetuity. That's it. That's the math. Why do we spend a semester on it? Because the math isn't the hard part. What are the assumptions we put in? Because actually predicting the cash flows, it's far more uncertain than the bonds. And that is why there's an art to valuation. And that's what we're going to be talking about. So the people that actually have to do this for a living, they're analysts that you could eventually be, fall into two categories. They're called the buy side and the sell side. What's the difference between a buy side and a sell side analyst? Yeah.
The buy side's like a wealth manager, like buying actual stocks. Like sell side's like an investment bank.
Yep, that's a very good distinction. Matter of fact, you did a better job than most of the people on last year's essay question on the final exam. because I actually asked this question. And basically, seriously, a lot of the answers were the buy-siders buy and the sell-siders sell. Okay, I enjoy this. I give them zeros for the credit for the answers, but I enjoy these sometimes. Comedy is good. But no, that's actually a better answer, is that literally the buy-siders are the people that own the stocks. So they're the institutions, like Fidelity, like BlackRock, like the hedge funds, that actually go out and own big blocks of stock. Okay, and by the way, they went to the business schools that you're going to and got the education that you're getting about how to price these stocks. So let's take Starbucks, since I'm here. In Bloomberg, HDS stands for holders, and this is a list of all of the corporate ownership of Starbucks, scrollable, and 81% of their shareholders are in the scrollable list, starting with the largest shareholders: Vanguard, BlackRock, State Street, Capital Group, Morgan Stanley, Howard Schultz, etc. Okay, and by the way, I can scroll down to this list, and here's some people that own like, 200 shares of stock.
Is that only institutions? Or
Yes.
Okay.
These are institutions. Now, the employees are typically under a trust, like a company like State Street. So if you ever see State Street, that's actually the employees. Okay. So if you look at Starbucks, State Street, these employees own about 4%, and then Howard Schultz owns about 3%. So about 7% employees. Okay. But nonetheless, 81% are in this list. But the key point that I want you to understand is this: how many shares they own, and these are the buys and sells. If I own 100 shares of Starbucks or 10 shares of Amazon and I sell that, it has no impact on the stock price. But if Vanguard sells 250,000 shares of Starbucks, that's going to impact the stock price. So one of the things you're going to quickly learn in the class is these people, particularly the top 15 or 20 institutions, are the price setters, right? Because they're doing the big blocks and they're pricing these big blocks, and that drives the stock price. Okay? So, by the way, if I took, who's been selling here, Capital Group companies, sold 16 million shares. So here's this fund, sold 3.8 million shares. So obviously this company does not like Starbucks as much. So this is a relatively small fund by today's standards. It's only $78 billion of market cap. It only has 258 companies in its portfolio. And essentially these are the portfolio. Its biggest holding is Amazon. Its smallest holding is a company called Bright House Financial, LG Display, Royal Dutch Shell. So you can see who the 258 companies are. So here's the thing. There are 15 GICS sectors, right? And this is the 50% number I gave you earlier. This is called sector rotation. I, the fund manager, like healthcare. I don't like tech. So what I do is I start selling tech and I add more to my healthcare, right? Because here's the point. If I think that the tech market is a little high valued or it's going to have some problems with some of these tariffs and other things that are being implemented, I start minimizing my tech stocks. Now, it doesn't mean that there aren't some companies in there that could do well, but part of the reason why your stock price goes up or down has to deal with the industry, not the company. And even the portfolio managers understand this because they want to be in the good industries, not the bad industries, right? So here's the important question. If I'm a fund manager and I'm on a team of like 3 people, me, an MBA, and an undergrad, and I got to keep up 258 companies in 15 industries and all their competitors on a real-time basis, can I do that effectively? So I need somebody to help me that's a specialist in each of the companies to help me make my decisions. That's called the sell side. So the sell side are the investment banks that he mentioned that work for the banks, and they don't own stock, but they're the people that write the buy, sell, hold opinions that are my consigliere that basically advise me so I can basically buy or sell because I can't keep track of everything, and they're the specialists that are helping me out. Okay, so specifically for Starbucks, ANR and Bloomberg are the analyst recommendations, and it's very specifically these 35 analysts. Okay, it's Jeremy Scott of Mizuho, Nicole Reagan of Piper Jaffray, Christopher O'Call of Stifel. Anybody here work for any of these firms? Summer interns? Do you know any of these people? Who'd you work for?
Yeah,
Which one?
I worked at Stifel.
Stifel? I keep calling them Stifel. They get mad at that. Do you know this guy, Christopher O'Call?
I don't personally know him.
Okay. But the point is, these are the analysts, 35 of them, that write the buy, sell, hold opinions. As of today, 18 of them say buy, 17 say hold, 0 say sell. On a 5-point scale, buys are worth 5, holds are worth 3, sells are worth 1. Starbucks is a 4.03 out of 5. But you can see the consensus has been going down over time. Less buys, more holds. Now here's the thing. They put in target stock prices. Wisdom of the crowd, Bloomberg aggregates the target stock prices. 12-month target stock price, $58.20. Today they're at $53.03. That means 10% upside over the next 12 months. And by the way, in the last 12 months, Starbucks is flat. So these are the calls of the analysts. And so let's talk about Christopher O'Call, who's got as of August 17th, a $55 stock price. Got a hold. So I'll come in here. And this analyst has a coverage universe of 16 companies. His job and his team's job is to know everything he can about these 16 companies. By the way, if you want to look at the biography, they have their own little LinkedIn profile. So that's his phone number. He works in St. Louis at One Financial Plaza. And most of the time they'll give you an email address. We don't happen to have it for him. But these are real numbers and real email addresses, real addresses. So if you're in the job search mode, you want to start talking to the analysts, they may not want to talk to you, but you can reach out and touch them. And by the way, if you ever see a green dot over here in Bloomberg, that means they're online and you can text them within the terminal, real time. And that's actually more effective because people are used to answering the text because they think you're an institution than if you text them on the phone. Not that I'm encouraging you to do that, but I'm just letting you know how things work. All right, so let's go back. So here's the thing. I'm working with Google. I'm working with SAS Airlines. All right, I'm working with a medical company with some Optum people in it from United Health Group in San Francisco tomorrow. But I can't call the CEO of those companies. They're not going to talk to me, no matter how good a job I do. But this guy does. This guy can call Howard at Starbucks and say, hey, Howard, what's going on? And then he can turn around and he can call the CEO of Yum. He can call Chipotle. He can call Wendy's. He can call Papa John's and say, what do you think? And so the one advantage these analysts have is unprecedented access to the CEO, CFO, and investor relations of the industry. And they can put together an industry view that sometimes the companies themselves can't put together because they can aggregate that. And that's valuable to the buy side. Here's the other thing they do. They upload an Excel spreadsheet with a forecast of the income statement and balance sheet, EEO, very important screen in Bloomberg, earnings estimates. And this is a real-time view of the earnings estimates for Starbucks. So they, in Excel, forecast out the next 5 years of income statements and balance sheets. They upload it to Bloomberg. It's averaged, wisdom of the crowd, and this becomes the consensus estimate. So this is what I mean by the forecast for the future. Is Starbucks is worth the sum of its future cash flows. The analysts who are closest to the industry and know the most, not that they're perfect, the wisdom of that crowd believes that Starbucks will hit these numbers over the next 4 to 5 years. Here's revenue. Last year, $22 billion. By 2021, $31 billion, as an example. All right, and again, there's a forecast for free cash flow. $2.6 billion growing to $4.2 billion. So the point of the story is that this sets the baseline for price. And some institutions will be slightly above or slightly below, but this is core to the valuation because this is the value of the companies. Does this make sense? Questions about this? And by the way, here's your hint for the stock simulation, which is this. The Bloomberg Trading Sim, it's about expectation management. Meaning, when a company reports earnings, there's already a baseline. So I price you based on the expectation. When new earnings come out, new information changes the baseline. That's what's going to cause the stock price to go up or down. So that's actually how you win the stock simulation. Because if you basically do your homework and you say Starbucks is a good company that will generate good, consistent cash flow in the next few years, growing rapidly in China, everybody already knows that. That's already in the price. There's no value to that. Okay, so the value is what's different that's going to adjust this baseline. That's what's going to be key to paying attention, but this is the tool, because there's the next piece. If you wanted to understand Tesla, just as an example, this is what matters to Tesla. And this is the question that Wall Street is going to be asking Musk in the next 3 months. This is a forecast of revenue for Tesla last year versus 2021. This is a profit forecast, EBITDA, 2021. And this is a cash flow forecast for Tesla, 2020, 2021. That's forecast. But here's the question. Tesla's going to run out of cash sometime this year, right? Given that they already have more accounts payable than cash on hand, before they even keep burning cash, they're going to run out of cash. They're going to need to raise cash. And so the question that the institutions have to ask is, do you believe these numbers? Because if you believe these numbers and you think Elon Musk's company can sell $42 billion worth of cars, make $6 billion worth of EBITDA, or sorry, $8 billion worth of EBITDA and generate $2.8 billion of positive cash flow in 3 or 4 years, are you willing to give them a $3 billion lifeline? That's the question. And what I'm telling you is if you want to know why Tesla is valued as they are, it's not based on the fact that they've been losing a lot of money. It's based on the fact that people think that they're going to get to these numbers. Now, here's the granularity you're going to get into, which is this is a forecast of volume by type of car. And the real key is the Model 3, which is supposed to be the $35,000 car. They're supposed to ship 500,000 of them in 2 years. They're supposed to ship 164,000 of them this year. If you read the papers, they're making how many Model 3s a week? 5,000. Let's give them credit for halfway through the year, 5,000. How many were they making in the first half of the year? More like 1,000. And they're having all sorts of quality problems. And Elon Musk is saying that he works 120-hour work weeks on the factory floor in the tent that's next to the manufacturing facility, helping them keep on the 5,000 car production line. And then they got to scale up next year to how many? What's 316 divided by 12?
30.
What's divided by 4?
7.5.
So they need to scale up to 7,500 on a consistent basis. So what I'm telling you is every headline that comes out right now, people are reading the tea leaves, and it's not just the numbers, it's do I believe the deliveries? And do I believe that they're going to be able to do this? So what I'm telling you is this is what's going to drive valuation. And this is what we're going to be focused on this semester when we start valuing companies. Because it's your judgment call about how realistic these numbers are as to what their price really should be. Does that make sense? Okay. By the way, the final one we'll talk about is competitive advantage. That's the fourth cornerstone. And the key, which we'll pick up on Wednesday, is competitive advantages don't last forever. And so it's not does a company have advantage, it's for how long. And more importantly, it's called the wave theory. Can they catch the next wave? Right? Because I know Apple is doing really well with the iPhone, but I also know that the iPhone, just like the Nokia and the BlackBerry before it, it's not going to last forever. So what's next? And can Apple get to what's next? Otherwise, they're going to go mature decline. So those are the 4 cornerstones. That's what we're going to build on. What I would say for Wednesday, try and get the book. Start doing the readings. Start introducing yourselves to your peers for potential teams. And then last but not least, start with the Bloomberg Certification as soon as possible. See everybody on Wednesday. What's today? 27th?
20, yes.
Sorry, Royce.
Yeah.